The S&P 500 bounced higher today, largely off of the U.S. GDP report that showed the U.S. economy growing by over 3%, which did beat analysts' expectations. We also saw Uber come in after hours here tonight with their first earnings announcement since they became a publicly traded company, and that stock is higher. It wasn't all roses, however. We did see the Russell 2000 sell off here yet again today. In fact, things have gotten so bad with the Russell 2000, we now have an oversold cluster signal. So perhaps we're setting up for a little bit of a reversion to the mean type of a bounce higher here in the next week or so. So we'll keep our eye on that. In our trade application example today, I did want to focus on a sector that's been struggling as interest rates have been falling and focus on a bearish trade setup. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's May 30th, 2019. First of all, if you're new, welcome aboard. Remember to go to YouTube, sign up for our channel there, and while you're there, check out our description area where you can access our email distribution list. We also are heavy users of Twitter. My handle is @BrandonVanZ, and we also have a presence on Facebook. Join us at the web address embedded in the logo in front of you. All right, let's go ahead and dive into the charts. As you can see, I've got chart 4B pulled up here in front of us for those of you that are premium market scholars that want to follow along at home with your own charting package. As a reminder, this 4 grid here looks at the 4 major U.S. equity indices, and each one of the charts is 3 months in length. Each one of the candles is 1 day in length. The background colors of the charts tell us whether we have a bullish or a bearish posture. In fact, that was one of the questions I received in my question and answer session here today. So for those of you that are premium market scholars, feel free to go check out that recording once it becomes available, where I explain the color backgrounds, not only for these charts, but also for chart 1A, which is what I use in my top-down trend trading classes on Mondays. Anyway, the background color in this case is a dark pink shade. And what that references is that we have what's known as a strongly bearish posture on all 4 of these charts right now. Remember, we get that strongly bearish posture when the green line is falling and below 50, or if it's just simply below 20 at all. If it's below 20, it doesn't matter whether the green line is rising or falling. It is considered strongly bearish. If the green line is somewhere between 50 and 20 and the line is falling, that's where we would also consider that strongly bearish. So that doesn't change. We've had a strongly bearish posture for the last several sessions. So not a big surprise there, despite a little bit of a pop in the S&P 500 today, which was up by 0.21%. You can see that the Dow Jones was also up today, up 0.17%. The NASDAQ was up 0.27%, so that was kind of our leader here today on the upside. But the Russell 2000 was the outlier. We were down yet again on those small cap stocks, down 0.3%. And if I were to right click on this chart and go to maximize sell, you can see here what I referenced in the intro, which is we now have an oversold cluster signal on the Russell 2000. And as you can see here, this is the first time that has occurred in the last 3 months. So while we've had some pretty significant pullbacks here over the last 1 month, today is the first time you could make the claim that we are now considered to be oversold according to the market forecast technical indicator. Remember, there are other technical indicators out there that have their own parameters for overbought and oversold. But for the market forecast perspective, we now could be considered a bit oversold there, as the blue line, the red line, and the green line on the market forecast are all closing in the lower reversal zone on the same day. You can see that that blue line just barely got down there. Remember, you can read the labels over here into the left if you want to see the most recent reading, and you can see that the near-term line, that's the blue line there, closed at 19.92 and falling. So in other words, just a hair below that 20th percentile there on the chart. You'll also notice in the background there, we have this kind of orange dotted line that's being plotted, and that is our longer term market sentiment line. So that would also be considered bearish at this point. But as we've mentioned in the past, when things get a little bit overdone, it is possible to see a reversion to the mean type of a move. Now, just keep in mind that because we might be a little bit oversold right now doesn't guarantee that we're going to go up dramatically and change the trend or anything like that. Sometimes an oversold condition gets worked off by just seeing that security go sideways rather than continuing to go down. Sometimes we'll get a little bit of a pop higher, but more times than not, it doesn't necessarily change the trend. It's just kind of a momentary reprieve. So for those of you that are quick to get in and out of your trades, perhaps that creates an opportunity if you're comfortable being a little bit counter trend. Remember, we are nearing the end of the month here as well. And one of the odd things about the way that the calendar gets set up, if you go back and record all of the days in history that are the first trading days of the month, more times than not, those are positive days. Tomorrow, of course, is the last day of May, but early next week, we're going to have our first day of June. And if you look at the Stock Traders Almanac, which comes out every year, they do have some statistics in there that show you that more times than not, the first trading day of the month does result in positive gains. So perhaps that lines up nicely with this oversold system here as well. If we were to go back a little bit further in time, I just am curious how the Russell 2000 has done with oversold cluster signals in the past. And you can see that it's a bit of a mixed bag, quite frankly. You'll notice that over during this time period here, I don't know if that's exactly the type of movement that you would have been interested in, because a lot of these cluster signals were stacked up here, kind of in the mid-October time period. And yes, you did get a reversion to the mean rally eventually at the end of October into early November. But depending upon when you took action upon that, you may or may not have made money off of that move. For instance, had you taken a trade off of that first cluster signal, you would not have been made up for that move. On the other hand, if you took the signal on the last cluster signal, you had a really nice rally after that. These ones over here worked out a bit better at the end of December of last year. There you can see it was basically day after day after day. In fact, that was very rare and unique. I remember David and I discussing that at the time, where we had 1, 2, 3, 4, 5, 6 straight clusters on the Russell 2000. That is almost unheard of. Well, had you been buying during that time period right there, you would have had a nice result, because as you can see, that snapback rally was strong enough where you would have been made up for all of those moves right there. So where we stand right now, of course, is just the first cluster. And they don't always have to bunch up with multiple ones like we saw here and here. You know, we've seen plenty of times in the past where there is just one, and then it does rally. But just want to kind of remind you folks of that just because we do have an oversold cluster signal now doesn't mean that we can't get another one tomorrow or next week or what have you. So right now we'll just have to see where it takes us. But perhaps there is a glimmer of hope there that we're nearing the end of this most recent move lower with that oversold cluster signal. All right, let's go ahead and take a look at some other charts now. Let's take a look at chart 4C. This will be our 3 green arrows chart setup. And here, what we're looking at as far as the background colors is whether we have 3 green arrows, 3 red arrows, or a mix of green and red arrows. And these are the same 4 indices, and they still are 3-month daily candle charts. So as it stands right now, we do have 3 red arrows in all 4 of the charts because the background color is pink there. So it is letting us know that price is trading below a 30-day moving average in this case. The MACD histogram reading is below 0, and the stochastics is letting us know that the bears are in control and closing prices near the lows of various trading ranges rather than the highs. And so that is the case with all 4 of these charts right now. Not only that, but I would also add to it that notice that the moving average colors are also all red right now. And what that means is that price is below a falling moving average, which is a pretty healthy change of pace considering we had green moving averages for much of the last 3 months as prices were above rising moving averages. So May has definitely been kind of a pivot month. And as the old saying goes, sell in May and go away. That seems to be working so far in 2009. We'll see if that continues to work throughout the summer or not. Let's go ahead and take a look at our next chart setup, which will be chart 4D. And this is our longer term chart now that we're looking at. This is our 1040 crossover method chart, and these are the same 4 indices, but we're looking at 3 years worth of time in each of the charts. Each one of the candles represents 1 week in time. Now there is something new to report here, but I don't want you to get overly excited about it until tomorrow. As I've been kind of mentioning in my presentations for really the last month or perhaps 2 months, that if we were to get a negative crossover on one of these 4 charts, it was likely to occur in the Russell 2000 first. And the reason for that is it just had been the laggard compared to the other indices that were out there. Notice that the Russell 2000 was not able to achieve a new high like the S&P 500 put in a new high that just barely got above this high back here. The NASDAQ also put in a new high that just barely got above this high here. But notice that the Russell 2000 wasn't anywhere near breaching its high from several months prior. So it had always been the laggard. Well, you'll see what's happening right now. In fact, let me right click and maximize this sell. Now again, I want to warn you that today is only Thursday. If we got some sort of a massive market rally tomorrow, there is no guarantee it closes the week with this condition. And remember, that's what is important here, because we are using this on a weekly candle chart. And remember, what we're looking at here is a orange line that represents a 10-week moving average and a blue line that represents a 40-week moving average. And right now we are getting a bearish crossover there. Some of you will refer to that as a death cross that's taking place as of this exact moment in time, and we'll know for sure tomorrow afternoon when the markets close whether that is officially locked into place or not. Right now it is looking like it is going to happen, and we do see that that orange line is now trading just a hair below that blue line right there, and you can kind of see it down below with the MACD 2 lines as well, where that black line is now a hair below that pink horizontal line down below. So again, that doesn't necessarily guarantee that there's going to be some massive bloodletting in the market going forward or anything along those lines. But when somebody is using the 1040 crossover method, they're trying to help have the market help them gauge whether they should be in the market or not, whether it's quote unquote safe. Now keep in mind, you can have chop in this type of a technical indicator, just like you can in any technical indicator. There is no technical indicator that's 100% out there. So it's entirely possible this will just be a choppy era. On the other hand, of course, if we do have some sort of a prolonged bear market, then things like this can kind of give us an advance notice that there is going to be continued pressure on markets, with the theory that the more sensitive moving average, in this case the 10-period moving average, is crossing down and below the less sensitive moving average, or 40-period. So the more recent time period is dramatically worse than longer time periods, and therefore markets are being pressured right now. So anyway, the other indices are not challenged from that perspective right now. Notice the gap here on the Dow, notice the gap here on the S&P 500, and here on the NASDAQ. All of them are rolling over, no doubt, but it's really the Russell 2000 that remains our problem child and is likely to go into the weekend with an official death cross. All right, let's go ahead and take a look now at our 12 grids. And we'll start off with chart 4E. As a reminder, when we're looking at these 12 grids, the background colors will determine whether we have a bullish or a bearish posture using the market forecast intermediate term line. And as we look at this first set of 12 grids, chart 4E, as a reminder, this is our intermarket analysis here. And so these ones don't necessarily have anything directly to do with stocks. We'll get into that in just a little bit. But I did want to point out a couple of things that has been taking place here recently. Kind of the talk of the town is what's going on with interest rates. As you can see, TLT exploded higher yet again today. In fact, we closed at our highest level on TLT. So, money is scared right now, or at least that's one of the things that you can think about when you see a chart that looks like this. When the stock market is struggling, like it has been, and the TLT is going straight up, basically means that money is a little bit nervous being in more risky equities and feels a little bit more comfortable going into government bonds, where there is some sort of a guarantee of a return of your money. Remember, the stock market cannot offer you a guarantee of a return of your money, whereas the U.S. government can, assuming that the U.S. government does not go out of business. And remember, right now, the U.S. government, with as low of yields as they are, and remember, we are looking at 2.22% yields on the 10-year Treasury, those are very low yields for those of us that live in the United States. However, remember that across the globe, places like Japan and parts of Europe actually have negative 10-year interest rates. And so sometimes you find foreign money flooding into the United States to take advantage of our government bonds, even though we might look at them as offering quite a little pittance. And you'll notice down below here, the US dollar continues to be strong. So perhaps that is part of the story that's playing out as investors from Japan or Europe take their money to the United States. They need to exchange their yen and their euro into US dollar, and that creates kind of a supply-demand imbalance there where prices have to resort to going higher if there's a lot of demand for our dollars. And so that process continues to play out. It has been playing out for a while, but if you're looking for trends out there, you might not be able to find great looking trends in the stock market. But as we've been saying for some time, the US government bonds and even foreign bonds right here are looking quite intriguing and could be a place to park your cash until things get sorted out in the stock market. Some of the other areas here on this chart aren't quite as rosy as bonds. Notice that crude oil remains a challenge for this market. Crude oil got absolutely annihilated today. Crude oil was down over 4%. In fact, we are very, very close to 3-month lows. Keep in mind context there. Up until this date here where we topped out on April 23rd, crude oil was one of the best looking charts in the market on a year-to-date basis. Remember, this chart is a rolling 3-month chart that you're looking at down here, but we could probably change that to a year-to-date if we wanted to. Yeah, there it is. So let me flip that over, and you can see crude oil was basically in a nonstop uptrend from January 1st here until April 23rd. Since April 23rd, we've actually started to form downtrends. Let me maximize that cell so it's easier for you guys to see. So this is the year-to-date chart. Crude oil was basically forming higher highs and higher lows for 4 or 5 months, and then for the last month or so, we've seen the exact opposite. Notice that when crude oil came down to this moving average, the assumption at that time would be that we'd get a bounce off that moving average. After all, that's exactly what we experienced back here on March 8th, and that's exactly what we experienced back here on February 11th. So when we saw the crude oil market come down and touch the moving average here, there wasn't a whole lot of concern at that point, especially with that next day bounce, and we thought perhaps we'd be up and off to the races again. Well, that's not what the market had in mind for us. Instead, we spent a little bit of time above that moving average, decided that we wanted to slice through it. This was a pretty ugly candle right here, and since that candle, that was kind of a game changer. Notice that after that candle, we basically went straight. We had a little bit of a reversion to the mean where it looked like it wanted to rally ever so briefly, but it just could not stay above that moving average. And it rolled over. And now you're looking at a series of lower highs and a series of lower lows. And that remains a concern for this market because, of course, crude oil is oftentimes a barometer or a proxy for economic activity. And when you see crude oil starting to struggle like it has, it leads you to believe that some of those energy and industrials and material stocks are going to have a hard time making profits in the future. Let's go ahead and take a look at our next chart setup now. And this will be chart 4F, and these will be our foreign stock markets chart. So as we look at this, you can see we have more red than green on the board. We do have Brazil and India kind of bucking the trend and having bullish postures right now. In fact, India is so strong, it's almost in the upper reversal zone. Notice here that the intermediate line is at 79.34 and rising on India. Of course, they just had their elections here recently, re-elected Modi. Let me go ahead and maximize that chart so you can see down below that this green line isn't just bullish, it's almost in the upper reversal zone. There's not a whole lot of equity markets around the globe that could make that claim where the green line is as close to the upper reversal zone as India is right now. So if you are a little bit more comfortable on the bullish side of the market, perhaps India is a place that you put on your watch list, put on your radar. I'm not sure I'd be overly enthusiastic here just simply because the price is very close to some of these topping out zones from earlier in March and April, but nonetheless, this is definitely a security that has a lot of relative strength right now compared to most other securities around the globe. So keep India on your watch list. That is an area that's gotten a lot of juice here since their elections recently. Other areas around the globe have been much more difficult to find bullish postures. However, some of them have gotten so bad, perhaps there's a possibility of a reversion to the mean on the horizon. Notice Canada ended today with an oversold cluster signal. We also had, it was Israel that ended today with an oversold cluster signal as well. That's EIS. I know that one's not quite as popular, but nonetheless, we do have Canada and Israel with oversold cluster signals, much like the Russell 2000, and therefore perhaps we can get some sort of a reversion to the mean type of a move. And keep in mind that some of the other securities like China, like South Africa, and like the United Kingdom have had oversold cluster signals at least once within the last week or so. So while they don't have them necessarily today, we could still be within that general time period after the signals where we're still in that possibility of a reversion to the mean type of a bounce. So, but like I said with the Russell 2000, just because a reversion to the mean type of a move could be made does not mean that all of a sudden these trends are going to change from downward trending securities to upward trending securities. It just means that, stocks don't go down every single day, just like stocks can't go up every single day. And therefore, we might get a little bit of a bounce here at the end of this month into early next month. Let's go ahead and take a look at our final set of 12 grids now. This will be chart 4G, our U.S. sectors 12 grid. All right, here things aren't looking so great. As you can see, we have a clean sweep for the bears. All of these charts are pink. In other words, we have bearish postures on all 11 sectors at this current time. Now, keep in mind, we do have some sectors that are slightly better than others on a relative basis, but all of them do have bearish postures according to the market forecast technical indicator. The ones that probably are holding up a little bit better are the ones on the bottom rung down here, which are staples, utilities, and real estate. Notice that most of their price action is very close to the moving averages. Whereas when you start looking at some of the other charts, I'm looking at like discretionary. Look at how far away it is from the moving average. Look at industrials, how far away it is. Look at materials. Look at energy. Those things are just sick right now. In fact, again, getting some oversold cluster signals in the last week on many of those charts as well. But, we've got a lot of work to do to get this market back to the robust state that it was in earlier this year. Whereas we do find a little bit of strength seems to be in more of those defensive areas that you're recognizing down below here. I also wanted to point out briefly, the financials were down today. Even though the S&P 500 was up 0.21%, the financials were down 0.34%. Remember, generally speaking, financial stocks struggle if interest rates are falling, and that is what we've found ourselves in here recently. In fact, there's been a lot more chatter here again about inverted yield curves and the like. Well, remember that a lot of banking and insurance and brokerage stocks struggle when interest rates are falling because their net interest margin is not quite as robust as when the opposite is true. But nonetheless, I wanted to point that out because our trade application example here in a little bit will come from the financials area. Before we get to that, I do want to point out, if we come back over here to the internet briefly, first of all, thank you to everybody who clicked like the last time I did the video. Exactly 100 of you did that, and that, as many of you know, that's kind of my bogey that I'm shooting for. If we can get at least 100 people to like these videos, then I can justify doing them on a regular basis. If less than 100 people get value out of these videos, then we have to question whether the couple of hours that we carve out of our day to do these free YouTube videos are worthwhile or not. So thank you to all of you to do that on a consistent basis. Please keep it up. Remember that tomorrow David's got his very popular technical analysis trading room at 11 a.m. Eastern time, so feel free to join that as well. But also wanted to point out the sector selector. Now, this is from last Friday, so it's almost a week old at this point, but I did want to point out that utilities, real estate, and staples were number 1, number 2, and number 3. I'll have a new ranking tomorrow night, so be on the lookout for that. I'll, of course, post it to Twitter as well. But as of right now, we do see those defensive and interest rate sensitive areas of the market holding up better than a lot of these energies and materials and discretionaries down here at the bottom. And remember, this goes beyond price. This is using 10 different technical indicators on an equal weighted basis to kind of get a little bit more insight than what you would be able to uncover on your own with just pulling up price charts of all of these different sectors. All right, so with that out of the way, let's go ahead and take a peek now at our trade application example for the day. As I mentioned before, it's going to come from the financial space, and it will be a very popular stock many of you are aware of. In fact, it had been one of the better performing banks out there, but has fallen on harder times here more recently. And this is JP Morgan, of course, one of the big companies in the Dow Jones. You can see that JP Morgan, after having a nice run of things a couple months back, has now found itself in the midst of lower highs and lower lows. Notice that you also have what's known as a bearish engulfing candle that took place here today. And obviously, we've had some changes here recently in terms of posture going from bullish to bearish here, maybe about a week or so ago. In fact, it was exactly a week ago when that happened. But since that last week, we now have one more bearish element of the chart, which is this moving average has changed from green back here to yellow during this time period to now red here with the last couple of days. And what that means is the moving average is no longer going up. The moving average is now going down and prices below that falling moving average. And so when we see that type of behavior take place, it makes us wonder if it will be used as a resistance area the next time it approaches the moving average. What we do know at this point is that the last time we breached the moving average to the downside, which is during this time period, we had a couple of attempts to get back above that moving average right there, and somewhere in there. And each time it was rejected. That moving average was kind of a launch pad lower. And so that's kind of the hope when you're looking at bearish trade setups like this, is that when this moving average starts to roll over, and remember this is the 30-day moving average in this case, once it starts rolling over, it's going to be a force to be contended with. And if we do get some sort of a reversion to the mean, because remember, again, we're nearing the first day of the month, as I mentioned before, so we might get a little bit of a bounce because of that. We have some oversold conditions with the Russell 2000, some other areas. So I'm not saying we can't get a bounce here. We're probably overdue for one. But if we do get some sort of a bounce, perhaps that moving average will be used as a resistance area and the stock will kick back down lower. So what I thought we would do here today with this bearish posture chart of JP Morgan is what's known as a long put spread. And I've got it loaded up down below here. This is known as a debit spread as well, and it is a bearish trade. Now, just like you can buy a put and you are hoping for the stock to fall, you can also buy a put spread. And the reason somebody would want to do that as opposed to just buying the put outright all by itself is that when you combine it in a spread, you get part of your put paid for. Because in this case, you can see what I've got loaded up here. I'm using the July contracts with 50 days until expiration. These are just your normal monthly contracts. I've got the 110 put that I'm buying. So notice that says +1 over here, and that's the $110 put. I am then selling the 105 put against it. Now what that's doing for me is it's helping help me pay off the put in a way, because if you bought the 110 put outright, let me just show you how much that would cost. It would cost probably about $540. So notice that what's coming out of our pocket on this trade down below, where I've structured it as a spread, is only $249. So that's the benefit of setting up this as a spread as opposed to just buying the put naked outright. You get to kind of offset some of your costs in doing that. Now, there's always a flip side of the coin. The good news is we paid for part of our trade by selling a put against our long put. The downside of that is that if this thing just completely torpedoed lower, our gains are capped as this thing crosses below 105. At that point, we no longer make more and more money as the stock were to go down. So if you think JP Morgan is going to fall from like 107 where we're at right now down to, let's say, $90 by July, you probably don't want to structure your trade this way. On the other hand, if you just think it's going to be a meandering move lower and it's going to find itself just a little bit below 105, then this is a way where you can kind of somewhat finance your trade. So the other thing that I kind of liked about this is that you have a little bit of a head start with this one. So notice that if I were to take 110, so that's our strike, $110, and subtract out the debit, so in this case, $2.49, and I'm getting that right over here, notice that our break even on this trade is 107.51. Well, notice up above here, this stock is already trading at 107.06. In other words, this trade is already in the money for us. So even if JP Morgan didn't fall dramatically from here and just kept this level, technically we'd make a little bit of money if it just stayed exactly at 107.06 for the next 50 days. Of course, we want more than that, otherwise we wouldn't be doing the trade. Ideally, what we want to have happen is for this stock to fall from 107.06, where it's at right now, down to slightly below 105. That's where we would make max gain. And if you click confirm and send, you can see max gain is slightly more than max loss. In other words, we have a 1-for-1 risk-to-reward ratio right here, where we can make $251 and we're only risking $249 in this trade idea. So I'm going to go ahead and send that off, and we'll see if we can get filled first thing in the morning. All right, well, thank you for joining me here today. David will be back with you tomorrow. I'll get my sector selector out tomorrow night as well, so be on the lookout for that. But right now, our postures do remain bearish. However, with the Russell 2000 now with an oversold cluster signal, we might end up with some sort of a mini pop here in the next week or so. So be on the lookout for that as well. So that's all I had for you here tonight. If you got value out of tonight's video, as always, please click like and retweet there on Twitter. Until next time, best of success with your trades and your investments. Goodbye for now.